Chinese investment and trade with Africa has risen rapidly over the last few decades. This was in part a result of China becoming newly hungry for resources. China became net dependent on external energy in the early 1990s. This coincided with outbursts of tension in the Middle East, which is probably one of the reasons China went to some very greenfield energy markets like Angola and former Sudan. Investment from the mid-90s to the time of the global financial crisis focused on those energy sectors. For example, China was building infrastructure in Angola to help extract oil. More recently, it has relatively diversified into other areas of investment, building car factories in South Africa, rural roads, and commercial office towers from Addis to Dar es Salaam, and so on. China's involvement in Africa was criticised because governance issues were not central to the deals. At that time in Angola and Sudan, the domestic labour pool for large-scale infrastructure projects was also very weak and supplemented with cheap Chinese labour. Also, the money Angola or Sudan earned from the oil was sovereign export revenue, and China didn't judge how these countries would spend that money. They were therefore criticised because the use of the revenue may not have met standards that most local citizens and Western governments would have wished. Thanks to rising education levels and population ageing, China itself is now not home to the same volume of cheap labour, meaning local labour is now more used. Although trade between China and Africa is still dominated by commodities, investment has changed. China is now investing in production in small firms here and there in Africa. But China is not the major export market for most African countries. Maybe Chinese importers are buying the odd niche good like coffee from Rwanda or Ethiopia, but on the whole, more goods are sold regionally or to European or US markets. Even though China's labour is now more expensive, it remains home to an extraordinary industrial ecosystem that is very hard to compete with. However, there are signs of change. Globally, investors are now looking at Africa, at countries like Morocco, Egypt, and Ghana. From a China lens, what is interesting is what Jack Ma is doing. He's trying to connect African economies to his Small and Medium Enterprise Exporter Platform, EWTP, to allow Chinese buyers to directly liaise with small and medium enterprises in Africa and beyond, and even to help African entrepreneurs find buyers more easily in Europe. This might be instrumental in changing the relationship between Africa and China. It's interesting to compare China and Africa's labour. China's labour is more experienced and more expensive. The median age in China is nearly 40, where in most of Africa it's less than 20. China's labour is no longer cheap because of two turning points in the 2000s. One, around 2010, when the workforce as a share of the population peaked, whilst fewer births and rising education levels meant that there was a decrease of informal labourers. Africa will likely become a more dominant labour market in the 2030s and 40s, when China's labour market will be much tighter and more expensive again. However, two factors threaten this. Firstly, the fact that African workers are not yet as productive as Chinese workers. Secondly, Africa has a young population, and so many are not at working age yet. Automation is also a worry. Africa also has a lot to learn from China. Due to the one-child policy, China knew it would get old before it got rich, and most African economies will have this same problem. They should therefore use China's approach of setting up aging institutions and pensions. Lauren Johnston calls this the economic demography transition approach. Some African economies have longer to prepare. South Africa, for example, is going to reach peak working age population earlier and so has less time to prepare. Countries like Ethiopia, Rwanda, and Kenya are moving in that direction faster than other countries. One of two key things that China did was to map out exactly how long its demographic dividend would last. They could then understand that they had a 20 to 30 year long window as an opportunity to build the country. They used the money from that period to invest in education and science and tech. Now, in places like Beijing, Shanghai, and Shenzhen, people are far, far more educated. The strategy has been to hope that this smaller but more educated workforce can make China more productive. The tightrope, however, is also the need for more consumer-led growth into that structure. The old may be reluctant to spend their savings, and younger workers need to be sufficiently productive and confident enough to spend more freely than Chinese citizens of recent decades. When China was the world's export powerhouse, its fertility rate was about 2. Ethiopia today has a fertility rate of about 3 or 4, so the demographic underpinnings are very different, and one shouldn't confuse their potential to become China if the demographic story is different. However, Africa have a lot to learn from China and should especially look at the way they've managed the get old before rich plan. However, the difference in circumstance should also be considered. China became so important to Europe because this big high-income bubble in the West coincided with a big low-income bubble in the East. The West then did all the high-tech and services industries, whilst China did low-income manufacturing. And these two bubbles worked perfectly side by side until 2008. Around 2008, the working population share in China and America started to fall, and so the complementarity was lost. A demographic complementarity does have potential in Africa, but will have to become its own story. Moving on to the recent COVID situation, it's interesting to look at which sectors of African economies have been most affected by the contraction of the Chinese economy. First, the areas which rely on the import of Chinese parts. There's a lot of everyday consumption good trade from China to Africa, like mobile phones and consumer items. Consumption of these may have been affected by their lack of availability. Since COVID has stalled global tourism, it's had a great impact on holiday and tourism economies of the Indian Ocean and maybe Northern Africa as well. Mauritius's national airline even went into voluntary administration in April. The slowdown of Chinese production also has reduced the demand for commodities, leading to falls in prices, specifically affecting the oil industry in Africa. Also, countries that had made their plans for paying debt based on earlier high prices may now be struggling with some of the spillover effects across the whole economy. There is also a concurrent need to spend more on the area of health. Yet as African countries have huge issues in repaying their debt, this may be one of the key areas that is affected. African debt is a diverse story. On June 17th, Xi announced China would write off interest-free loans due to mature by the end of the year. China is also committed to a cessation of debt payments until the end of this calendar year, but these loans do continue to accrue interest. They have not agreed to give debt relief on the debt stock. In fact, since debt relief is something of a debt default, many African governments fear that debt relief will limit their access to credit in future, so they're not seeking a write-off but rather a restructure. China generally adopts a pragmatic approach to working out when repayment issues arise. This involves assessing whether a country's inability to pay is due to factors outside the government's control and whether it's likely to be permanent or temporary. Typically, the conclusion would be an extension of the repayment period, and in some cases, temporary repayment relief. Stock relief is only given on rare interest-free loans. China tends to prefer the economic outcomes associated with debt flow relief rather than debt stock relief. Moreover, China is not one lending agency, but many, even if led by China Export-Import Bank and China Development Bank. How debt sustainability analysis is undertaken is not clear, and neither is the process for approving loans, so it can be hard to draw China-Africa debt sustainability conclusions. Some fear that China will take advantage of the COVID situation and offer debt relief in exchange for other concessions. There are debt vultures all over the world, and some may be Chinese. But it's hard to say what will happen, as each borrowing country, each Chinese lending agency and project invested Chinese entity, and even each loan, is quite unique. By 2021, we will know more, as it's a big year for China's government. It's the 100th birthday of the Communist Party of China, and by Chinese custom, when you celebrate such an occasion, you should be generous. This animation is made by Jess Wallis of OxSID. It is based on Leo Bartels' interview with Dr. Lauren Johnston, Research Associate, China Institute, School of Oriental and African Studies, University of London, in June 2020. Further reading is listed here and available down in the description.